Hello and welcome to Econoday Unplugged on Tuesday, the 31st of October 2023. Many of the world's central banks have spent the best part of a year and a half tightening aggressively as they've strived to get inflation back under control. By contrast, the Bank of Japan has quietly gone about things in its own way. Its short-term interest rate target has been held at minus 0.1% since January 2016, and since September of that year, its yield curve control policy has successfully kept the yield on its benchmark 10-year JGB below 1%. However, going into Monday's central bank announcement, speculation was rife that all of this was about to change and that the BOJ might deliver a potentially key shift in its stance. I'm Jeremy Hawkins in London, and here to discuss what actually happened and what it might mean for the Japanese economy and global financial markets is Econoday's Japan expert, Max Sato. So, Max, welcome to you. First things first, what did the Bank of Japan have to do yesterday, and how did it compare with expectations?
Hi, Jeremy, and hi, everybody. Well, I think for some reason it was leaked out to the Nikkei during the blackout. But basically, Governor Ueda he has a kind of a hybrid approach toward what to do with the current situation. Since Japan is almost there to bring inflation up to stable 2%, now it's about the target, but not really anchored. So he still has to keep on doing that after 10 years of massive asset purchases and very low interest rates. But at the same time, when he took office in April, he immediately put together a plan to review seriously what went wrong and what was good with their policy measures. So even though they said they're going to spend the next 18 months reviewing the policy framework and everything, Ueda said he would rule out that some adjustments can happen on the way. So that's what he's been doing. But the main point is it's fairly hard to understand, even for me watching the bank for years.
Right.
It was really vague, but basically what they show in the visual image attached to the press release was in July, they said, okay, we don't think long-term yield is going to go up to 1%, but just in case, we set it as an ultimate defense line. So we're going to, whatever happens, we're going to defend it with the massive, bond purchasing operations. But since there was an earthquake of yield spike in the U.S. and the tsunami hit the Japanese shore, and basically they're forced by the market forces to push up the target range. But
okay, quickly, Max. Sorry,
okay.
can I just quickly ask you on that? So effectively, the so-called reference rate now for the 10-year has been raised up to 1%, but it's clearly not a precise cap. Do you think they would have made that move had it not been for the internationals, your pressures you're talking about from the likes of the way the US Treasury yields have risen right across Europe as well? Do you think they would have actually made that move domestically if the international factors hadn't panned out as they did?
I don't think so. The governor made it clear yesterday during the press conference that the part of the reason they did this was, of course, domestic inflationary pressures up. They had to revise up their forecast for this fiscal year next. But he said most part it came from the higher US yields.
Okay, I can just continue with this sort of side for the moment. I think also part and parcel of what was said, they've decided to end their daily fixed rate bond purchases, which presumably means it's going to be that much more down to the markets to actually set the level of prices and hence yields. I mean, do you think this is kind of like one of the sort of first tentative steps to actually pulling away from this yield curve control altogether, or do you think there's something else going on?
I think eventually they want to remove it, but politically they cannot say so because First of all, the government is trying to transform the economy from the guiding companies from cost cuts, which is a common practice for survival that has been in place for 30 years, towards sharing profits with workers and investing more in growth areas. So what the government is asking the Bank of Japan is to make sure you support the economy and help companies raise wages substantially in a sustainable manner. So that means the Bank of Japan cannot say, okay, we're going to do away with the current framework and start raising rates. They still have to say we're going to support the economy with patiently with basically monetary easing.
Okay, on that front, I mean, as you mentioned, the Bank of Japan's been buying bucket loads of JGBs in order to try and keep yields down and close to its target. I mean, are we at a stage now whereby it might actually be considering that the aggressiveness of its quantitative easing is simply too aggressive, given what appears to be, well, clearly it's been surprised to some extent by the level of inflation we've had in Japan, and perhaps we'll talk a bit more about that in a minute. But do you think it's got a stage whereby they actually themselves believe that the policy is being eased too rapidly simply because all the JGB buying they've been undertaking?
Sorry, the latter part. Can you just rephrase the latter part of?
Yeah, sure. Just in terms of clearly the one of the few banks around at the moment still very much engaged in quantitative easing via all the bonds they've been buying with a view to try and keep yields down. I was wondering if another reason for perhaps why they decided to let the yields rise is the fact that they've been pumping so much money into the system. They don't think that sort of stance is now appropriate given where the Japanese economy and inflation currently resides.
I don't think the staff or the actual board members think it's not appropriate, but more like they're wondering, wow, what are we going to do with all these bonds that the balance sheet and everything? We can't just say, okay, until yesterday monetary easing, today basically tightening. So that's going to really distort the markets, and also if they start unwinding obviously and aggressively, that's going to really hurt the market. So right. I think, as you can see, they've been doing kind of a stealth unwinding and trying to shed the actual net balance. But that's going to be a difficult task. But if you think that what did all this bond buying and super low interest rates did for the Japanese economy and people's mindset? Did it really help? So conversely, if they just get rid of them, is it going to really hurt? So that's going to be an interesting experiment in question.
All right, let me ask you a bit about inflation. I think they've revised up their inflation forecasts. I think just looking at the numbers I've got in front of me here now for the fiscal year 2023 and 2024, they've been both revised up from 2.5 and 1.9% respectively to 2.8%. But I noticed 2025, they've only increased the forecast to 1.7% from 1.6%. So it's still below the 2% target. So do you think that's their kind of fundamental justifications for not doing anything in terms of shifting the short-term interest rates, or indeed allowing the longer end of the yield curve to move even higher?
As you mentioned, the key is the fiscal 25 forecast. It's been only revised up to 1.7 from 1.6, which means they're not totally confident that the people's mindsets going to really change, and they expect wages to increase, prices to rise instead of fall. So they should probably spend and buy stuff now than wait till weeks later. So that if that happens, that's fine. But Governor Ueda also said yesterday that the primary way of the higher inflation is coming from higher costs. The secondary, which they really want to see, is wage pressures, and that's gradually happening. I mean, by Japanese standards, I guess a higher magnitude, but he said that's sort of factored into their forecasts, but they're still not sure whether the secondary wave is going to really come as they wish. So that means you can't just say, okay, 2.8, that's good enough. And then maybe yield curve name will remain, but effectively that's going to be fading. The very key point is when they can actually say, okay, it's safe to lift the negative interest rate to 0 or even above. That may not happen until well into next year. I mean, the first sign will come in early December when business leaders will say, okay, big businesses, they'll say, we're going to raise this much, or probably meet the demands of the labor unions. And for the fiscal year, that's 2024 starting in April. But that's just, the first round of negotiations, and only between the big companies and big labor unions. So you really have to see that's going to filter through to the smaller companies. And then the question is, okay, 2023, 24, we're seeing more wage hikes, but is that good enough? And what about, higher costs hit the gain, and it's going to remain basically cost push instead of demand pull. So that takes a little bit more time than maybe many market participants want to see right now.
Okay, fair enough. I've got to ask you about the exchange rate as well, because I guess, looking at the market's reaction to what came out of the BOJ, dollar yen clearly has appreciated on the back of it, which presumably means that markets were expecting something a little bit more aggressive from the Japanese central bank. So, I mean, we've had dollar yen trading above 151 pretty well throughout London trading today, and indeed certainly US trading it's pretty well seemed to have carried it on as well. Now, if I recall rightly, it used to be around about 152, I think, when we saw the BOJ intervening to try and cap the exchange rate last time round. Do you think, by virtue of what they've done today, that they're still concerned, or they still have some kind of pseudo limit to how weak they're prepared the yen to get, or do you think now they may be prepared to let the yen slide further, perhaps with a view to trying to make sure that inflation is that much more entrenched before they start moving short-term interest rates?
Yeah, I guess that's up to the Ministry of Finance and the communication with the U.S. Treasury. I don't know if the market force is so strong. I don't think they can win against the rising tide of the dollar. So they may not intervene when they don't think they can win. And plus, as I mentioned before, instead of yen selling operation when the yen was too strong, that's when Japan had big ammunition availability, they can basically print as much yen as possible, but they have to depend on foreign reserves. So they will be probably more cautious, and I'm just looking for data for possible intervention that might have happened, but day-to-day base MOF data is not going to be coming until November 8th, so we'll see if they actually intervene or not.
Okay, I mean, do you think if it became the case that the yen really came under pressure, they would be more prepared to allow the longer end of the yield curve to move higher?
I think they can always blame the external factors, like, okay, this is because the U.S. Treasury yields are too high, and we're just being hit by that. So that in that case, they can say, okay, maybe temporarily about 1%, a little bit more. But yeah, basically they've got a very flexible target.
They're easier to hit that way. Yes. All right. I guess that's kind of most of what I wanted to ask you. Apart from, well, I guess really, when do you actually think that they'll finally come round and raise their short-term interest rate target?
That's $1 million question.
That's why I'm asking you, Max. You're the man who knows.
I think if they want to play safe, it's going to be sometime in 2024. I'm not sure if it's the earlier part or later part. I think the key is, again, messages from both businesses and labor unions about how far the wage hike is going to be in fiscal 2024. Plus, is the economy facing another wave of, whether it's facing another spike in international energy and commodity prices because the war is going on, or pent-up demand. So they have to see all kinds of things. And Wera correctly said yesterday that it's not just wage hikes. They have to see other factors to make sure that demand is firmed up. The one thing they're not really attach so much importance right now is output gap. By some measures, it's now in positive territory, but BOJ is more cautious. And one of the factors Wera's predecessor Kuroda mentioned was he kept saying, okay, we need massive, easing because output gap is in negative territory. So that is gone, but they can't just use that one factor to say, okay, it's safe to lift the interest rates.
Yeah, good luck measuring the output gap as it is. Doesn't matter where you are. Okay, anything else you'd like to say, Max, before we close this one?
Yeah, I forgot to mention last time that there's this theory that Hanshin Tigers from from Western Japan, if they win the Central League tournament in baseball, the following year's GDP and also the Tokyo stock market, they're going to fare really well, and maybe that's going to happen. So now that the question is, I think the fans, not Tigers fans, but money is households still have excess, money, so they're really encouraged to invest in. Now the government is expanding the tax-free framework, so this system underneath that, so they're going to probably buy more stocks, and the funds may include bond funds too. But what does that mean? And according to the theory that the market's going to do well next year, so that means if people buy more stocks, are they going to buy fewer bonds or sell bonds? So is that going to affect the bond market, the long end, and then is it going to affect Bank of Japan's policy? That's interesting to see. Is it going to be buy stocks and sell bonds, or is it going to be Japan buying yen bonds both? Or is it going to be pulled down by the negative image of the yen, and is it going to be all Japan's sale again? So that's going to be another factor that we have to watch out for.
Plenty of unknowns and what's going to happen in that. Excellent. Thanks very much, Max. Clearly would have watched the baseball. Max, as a cricket fan here, given the state of England in the current World Cup, if you're looking for something to sell, it's got to be the pound. Right. Okay, then. Well, that's it for now then. Thanks very much to Max for his thoughts. And of course, you can read more on those and indeed the analysis of the whole Econoday team on our global economic calendar. Quickly, with regards to central banks, of course, don't forget the Fed will be announcing tomorrow and the Bank of England on Thursday, although with no big news expected from either. It could be, given all concerns about Treasury supply at the moment, that the US Treasury's refunding announcement also on Wednesday, that might well prove to be rather more important. In any event, as always, thank you very much for listening. The podcast will be back again soon, and we hope to see you then. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.